Hi everybody. So we're going to do our lecture today through a video recording as opposed to in class, and we're all going to hope and pray that my froggy voice will hold up for the 40 minutes or so that we need to get through this. Our topic today is conventional policy tools of the Federal Reserve. Let's go ahead and dive right into this. I want to just do a little bit of review to set the stage. Remember that we looked at the free banking era. We observed three salient problems from looking at the data and talking about the free banking era. We observed frequent bank failures and panics. If I remember right, 16% of all free banking era banks failed within the first year. The Kirtland Safety Society Anti-Banking Company would have been one of those types of banks that failed within the first year. Average life expectancy was about 5 years, and about 50% of all banks failed. The second problem that we witnessed in the free banking era was really extreme volatility in inflation and deflation. The money supply would expand and contract like an accordion, and that would lead to really problematic levels of inflation, followed by equally problematic levels of deflation. Not surprisingly then, if you've got banks failing regularly and if you've got wild swings in inflation and deflation, shouldn't surprise us that there were also frequent business cycle fluctuations. If I remember right, the average period of economic expansion in America lasted about 27 months. The average period of contraction lasted about 22 months. So we would have about 2.5 years of expansion followed by 2 years of contraction. Since the Federal Reserve has come into existence, those things have all changed and gotten a lot better. We've only had 3 bank panics in the last 100 years as opposed to 5 bank panics in the 50 years leading up to the creation of the Federal Reserve. Inflation has been incredibly tame, especially over the last 30 years. And we've seen our periods of expansion go to about, on average, 60 months. And our periods of contraction has shrunk to about 11 months. So things have gotten a lot better since the Federal Reserve came into existence. Well, we do have a Federal Reserve. We have a central bank. I think talking about what the problems were during the free banking era helps to give us motivation for what we want a central bank to do. And we talked about this in class. These are all the things that we think a central bank could and should do for an economy. First off, we would love for a central bank to monitor the commercial banks in an economy. One of the salient problems of the free banking era was frequent bank failures. We think a central bank could help with that. We could also make the argument that monitoring banks could be called a positive externality, and that's one way that we could easily justify the existence of the Fed, is to help us with that. Secondly, in addition to monitoring the banks, it would sure be nice if the central bank would serve as the lender of last resort. Remember during the bank panic of 1907, J.P. Morgan ended up serving as sort of the ad hoc lender of last resort, but we should remind ourselves even J.P. Morgan didn't have pockets deep enough to fix the problem. He had to cobble together a coalition of banks at the New York Syndicate. He had to bring John D. Rockefeller into the equation. He had to bring John Cortelyou, the Treasury Secretary, into the equation as well. So even in that moment when J.P. Morgan served as the ad hoc lender of last resort, even he wasn't big enough and didn't have deep enough pockets to do it. So we think it's wiser to have a government entity serve as the lender of last resort. They certainly have deeper pockets and stand in a position where they might be better equipped to see the big picture and to navigate a crisis. Also, and these next three we're going to call the Congressional mandate of the Federal Reserve. Our Congress has given them the task of maintaining price stability. I think one could make a strong argument that that should be the primary responsibility of a central bank. If an economy is going to use a fiat currency, we know that inflation is always a risk, and so it would be super helpful to any economy using a fiat currency to have an entity that would oversee the money supply and make sure that inflation doesn't get ginned up. In fact, we've noted in class that the European Central Bank has as its primary singular goal the maintenance of price stability in the Eurozone. We've given our Federal Reserve a couple of other congressional mandates. We've asked them to try to maintain maximum employment, and we've asked them to maintain moderate long-term interest rates. So those three are the congressional mandate of the Federal Reserve. We've also pointed out that the Federal Reserve rarely is able to accomplish all three of those things. So when push comes to shove, they have to choose which of those three congressional mandates to ignore. We've talked about the fact that oftentimes they ignore this third congressional mandate of maintaining moderate long-term interest rates. Well, Okay, so we've given our central bank a host of mandates and responsibilities, but we need to empower them to be able to accomplish the objectives that we've given them. Speaking specifically of the congressional mandates, maintaining price stability and maintaining maximum employment, these are the four conventional policy tools that we have bestowed upon the Federal Reserve. The target Fed funds rate, which is also known as open market operations. So the Fed funds rate is the rate that commercial banks charge each other to borrow money overnight. The reason we call it open market operations is because, as you'll see later on in the lecture, the Federal Reserve cannot just set the Fed funds rate. That rate is set in the markets. What the Fed can do is they can buy and sell securities to change the amount of reserves that exist in the economy, and that can move the market Fed funds rate to where the Fed wants it to be. The second policy tool is the discount rate. This is the rate that the Federal Reserve charges banks to borrow money overnight. So if you're a commercial bank and you need to borrow money overnight, you can either borrow from other banks at the Fed funds rate or you can borrow from the Fed at the discount rate. The third policy tool is known as the deposit rate or the reserve rate. The deposit rate is the interest rate that the Federal Reserve will pay commercial banks for any money that they have on deposit with the Federal Reserve. The fourth conventional policy tool is the reserve requirement. This is the percentage of deposits that commercial banks are required to keep either on hand in the form of vault cash or on deposit at the Federal Reserve. Excuse me. Well, let's take just a little bit of a digression and review what we've covered over the last couple class periods. We've been reviewing the balance sheet of the Federal Reserve. I told you that I viewed the balance sheet of the Federal Reserve as the Cliff's Notes version of the financial crisis. We were able to see in the middle of the financial crisis some very unusual things happening on the balance sheet of the Federal Reserve. We saw the term auction credit facility, which was about $450 billion. Those were intermediate and long-term loans that the Federal Reserve offered to commercial banks. Remember that the Federal Reserve is the lender of last resort. We want it to help provide liquidity in times of banking crisis. The financial crisis of 2008 was indeed a banking crisis. This term auction credit facility allowed the Federal Reserve to offer longer-term loans than discount loans would have allowed them to do. So that was one way that we saw sort of an unconventional intervention by the Federal Reserve during the crisis. The second unconventional policy tool that we saw the Federal Reserve utilize was the commercial paper funding facility. If you'll remember, when Lehman Brothers defaulted, it spooked the commercial paper market. The commercial paper market is the short-term corporate bond market. It's the corporate analog of T-bills. Usually only the highest quality borrowers are allowed to be active in the commercial paper market. Defaults are extremely rare. So when that happened during the crisis, all of a sudden investor appetite for commercial paper dried up. That created problems because we have all sorts of high quality institutions that rely on commercial paper as a source of permanent funding. The Federal Reserve realized that some of our really high quality companies that should not have experienced financial duress, were at risk of experiencing liquidity crises because they couldn't roll over their commercial paper. So the Federal Reserve stepped in and started buying commercial paper to the tune of about $330 billion. Also, globally, we experienced what's known as a global dollar liquidity crisis. So because we were in the middle of a financial crisis, markets were seizing up like the commercial paper market. Investors were sitting on their dollars. They were not investing in dollar-denominated assets. So there was a huge liquidity crisis globally, and it was very hard for foreign banks to get their hands on U.S. dollars because investors who had U.S. dollars were just sitting on them. So what the Federal Reserve did is they started offering central bank liquidity swaps to foreign central banks across the globe. In a very simple transaction, our Federal Reserve would offer U.S. dollars to other central banks. They would send us their currency, their local currency, and we would all agree 6 or 12 months later to just reverse the transaction. It was just a way for our central bank to put dollars out there so that people could consummate their global transactions using dollars. And if I remember right, it was $500 to $600 billion that were put out into the market through central bank liquidity swaps. The fourth form of unconventional policy tools that we witnessed during the crisis was the massive selling of treasuries. We experienced a flight to safety, so investors were buying treasuries at unprecedented rates. The Federal Reserve realized that if they didn't come in on the sell side, that was going to push treasury yields into uncharted and dangerous territory. So the Federal Reserve came in on the sell side to provide liquidity to a market that had a huge appetite to buy treasuries during the crisis. So those were the unconventional policy tools that we witnessed during the crisis. The good news is all of those things are done. So if you look at the current balance sheet, you won't see the term auction credit facility. You won't see the commercial paper funding facility. All of those weak spots in the dam have healed. They've been reinforced. We're not worried about them. But we do have a different dilemma now as we look at the Federal Reserve balance sheet. Right now, we see that the Federal Reserve balance sheet is at $4.5 trillion. That's about $3.5 trillion higher than before we started the crisis. Of course, that makes us all very concerned about inflation. And we asked the question last class, why haven't we seen inflation? Well, without going back through the money multiplier, the short answer is that excess reserves at banks has gone from about $1 billion to $2.5 trillion. So a lot of the $3.5 trillion that we've injected into the financial system is just sitting at banks in the form of excess reserves. The dilemma, however, is, and we talked about why banks are sitting on those reserves. There's regulatory pressure, there's economic pressure, and what we mean by that is interest rates are so low that banks just don't have much interest in lending out money if they're only going to earn 3.5% over 30 years. But the dilemma now is that the Federal Reserve has to stop quantitative easing. That's not something we can do indefinitely. You can't just balloon your balance sheet incessantly over time. At some point, you've got to shrink it back down. And they've even hinted at this, that they're going to stop quantitative easing. Well, when they stop quantitative easing, that's going to drive interest rates up. If you remember the bond market forces of supply and demand, what the Federal Reserve has been doing for the last 6 years is buying bonds. So they've been shocking the demand curve out. And as they've shocked the demand curve out, that's driven prices up. But we also remember that there's an inverse relationship between price and yields. So as the Federal Reserve has shocked demand out and driven prices up, yields have gone down. What that means is when they stop quantitative easing, the demand curve is going to settle back to a more normal level. Prices will pull back in the bond market and yields will go up. The reason that's challenging is if you think about it, as interest rates start to drive up, banks are going to have higher incentive to unleash these excess reserves in the form of loans. If excess reserves go down, the money multiplier will go up. And if the money multiplier goes up, we could very well see inflation. So what are the possible outcomes? I see three possible outcomes. The first one I'll call the Goldilocks outcome. That first outcome is that excess reserves start to shrink as banks lend more. But as the excess reserves are shrinking, which means the money multiplier is increasing, the Fed will reduce the monetary base. Now remember, the money supply is the monetary base times the money multiplier. The money multiplier will be going up as excess reserves shrink. The Federal Reserve could offset that by shrinking the monetary base, which is the same thing as saying shrinking its balance sheet, because remember, the monetary base is currency plus reserves, and that's the right-hand side of the Fed's balance sheet. So it might be possible for excess reserves to shrink as banks lend out more money. Simultaneously, the Fed shrinks its balance sheet, which reduces the monetary base, and they do this at a rate that both mitigates inflation but doesn't cause rates to surge. That would be the best possible outcome for everybody. I see two, however, less desirable outcomes. It's still very likely that we might witness some inflation. How would that happen? Well, imagine that excess reserves shrink as banks start to lend more of the money because interest rates are looking more attractive. What if the Fed fails to adequately shrink its balance sheet at an appropriate rate? If that's the case, the money multiplier will be increasing, but the monetary base will not be shrinking at a rate that will sufficiently offset the increase in the money multiplier. So if that happens, we would see inflation. Suboptimal outcome number 2, however, is recession. So how would this happen? Well, what if banks start to lend out the money so excess reserves shrink? The Fed understands that it needs to shrink the monetary base in order to offset the increase in the money multiplier. But what if the Fed decreases the size of its balance sheet at a rate that's too aggressive? And if they do that, what would happen is, if we go back to this, what that would mean is the Fed would no longer be buying bonds, they would be selling bonds. So what if the Fed drives the supply line out, but they do it too aggressively? If they do it too aggressively, you can see that prices would drop, which would push yields up. What that means is we might get a surge in interest rates, and if interest rates surged too rapidly, then we might actually be driven to a recession. So that's sort of where we're at, and that's a review of what we talked about the last couple days. But I want to come back to the conventional policy tools of the Federal Reserve. This is the last topic for us to really dive into. So again, these are the 4 conventional policy tools. They haven't been very interesting over the last 6 years because the Federal Reserve essentially exhausted all of these conventional policy tools by December of 2008. Nevertheless, we're all hopeful that we can get back to more normal economic times, and these conventional policy tools would again become very important. So let's make a few key points about these 4 conventional policy tools. Key point number 1. The Fed is trying to target interest rates in general. What they're going to do, however, is focus on the Fed funds rate. Now remember, the target Fed funds rate is the interest rate that banks charge each other to borrow money overnight. I like to think of this as the shortest end of the yield curve. Now remind yourself what the yield curve is. Here's a picture of the yield curve. So the yield curve maps out the yields to maturity on U.S. Treasury bonds at any given point in time as a function of the time to maturity. Now you might be sitting there saying, why are you calling the Fed funds rate the shortest end of the yield curve? Well, I need you to take a step back and remember what the yield curve is. It's the interest rate on bonds that have no default risk. That's why we use treasuries. But federal funds loans also have no default risk. We're talking about overnight lending between banks. There is almost zero default risk. So I think of the Fed funds rate as the shortest end of the yield curve. What the Federal Reserve wants to do is they want to impact all interest rates in an economy. So what do I mean by that? Imagine if the Federal Reserve is worried about maximum employment. So imagine we're in a recession, we're not at maximum employment, the Federal Reserve wants to change that. What they want to do is they want to drive interest rates down in the economy. Why do they want to do that? Well, remember that GDP is the summation of consumer spending, business spending, government spending, and net exports. Y equals C plus I plus G plus NX. If we can drive interest rates down, we might be able to motivate more consumer spending and business investment, and we might be able to get GDP back on track. So how are they going to do that? Well, they're just going to usually grab the shortest end of the yield curve, the Fed funds rate, and they're going to push down on it. And they hope that that works, and normally it does. And why does that normally work? The reason it normally works is because, remember, one of the stylized facts about the yield curve is that the yield to maturity of bonds with different times to maturity tend to move together. So if you can move one interest rate on the yield curve, you hope that the rest of the yield curve will obey. So that's a key point. The Federal Reserve actually wants to move all interest rates, but they're going to do it by focusing on the Fed funds rate, and they hope that everything else will trickle from that. So what we ultimately want to do is this. We want to say, all right, we know the 4 conventional policy tools: open market operations, discount rate, deposit rate, and the reserve requirement. We know that if employment is the problem, if we're in a recession, they want to drive interest rates down. We know the primary tool will be the Fed funds rate. So what will they do? with all of these conventional policy tools to get interest rates down in the economy? That's the question that we're really driving at today. Excuse me. Okay. The next key point. It turns out that the nexus, the point of convergence for all of these conventional policy tools is the market for reserves. Now, that might be an unfamiliar term, but you know what it is. Reserves are cash in the hands of banks. So when we say market for reserves, we're just talking about that market for cash in the hands of banks. So what we need to do is dissect that market. It turns out that the market for reserves, just like any market, has a demand curve and a supply curve. And we're going to have, just like in any supply and demand curve, we're going to have the quantity on the x-axis and the cost will be on the y-axis. But the cost in the market for reserves is the Fed funds rate. If you want to get your hands on money and you're a commercial bank, then what you will pay for that is the Fed funds rate. That's how much you'll be charged by other banks to get your hands on reserves. So let's talk about why the demand curve is shaped this way and why the supply curve is shaped this way. Let's start with the demand curve and let's ask a very simple question. Why do banks demand reserves? Well, you're acquainted with at least 3 reasons why banks demand reserves. First off, they're required to. The Federal Reserve requires banks to hold a certain amount of reserves. Secondly, liquidity needs. Banks like to hold reserves if it's not expensive because that minimizes liquidity risk. Third, banks like to have reserves because they can lend them out, right? This is a bank's business model, is to get their hands on reserves and to lend out those reserves. Well, if you think about it, these 2 factors down here driving the need for reserves, the demand for reserves, liquidity needs and lending needs, that is what gives the yield or the demand curve its downward slope. What we're saying is this: the cheaper it becomes for banks to get reserves. So if the Fed funds rate goes down, the cheaper it becomes for them to get reserves, the more reserves they're going to want to hold because it will help them with liquidity needs and they can lend it out to turn a profit. So that's why you get the downward slope in the demand curve. But next important question: why is the demand line kinked? In other words, why does the quantity of reserves run to infinity at this point on the Fed funds axis? Well, that point on the Fed funds axis is the deposit rate at the Federal Reserve. Now remind yourself what the deposit rate is. The deposit rate is the interest rate that the Fed pays banks on any money they deposit at the Fed. So imagine if the Fed funds rate somehow dropped below the deposit rate. What would happen is there would be infinite demand for federal funds. Banks would want to borrow as much as they could in the federal funds market because if the Fed funds rate was lower than the deposit rate, they could borrow an infinite amount at that low Fed funds rate, then deposit it at the Federal Reserve and earn this deposit rate, and that would be an arbitrage opportunity. So that's why if the Fed funds rate hits the deposit rate, demand would run out to infinity. So we view the deposit rate. We view the deposit rate as the floor on the Fed funds rate. It's a floor for the Fed funds rate. All right, next question. Why is the supply line nearly entirely vertical? So this is how the supply line looks. There is a kink. We'll deal with that in a second. The reason the supply line is vertical is because, remember from our demonstration in class the other day, reserves only change. The total supply of reserves only change if the Federal Reserve is involved in the transaction. You remember our thought experiment when we had our little closed economy with one bank and we put a whole bunch of constraints on the community. Remember, in that situation, in that hypothetical thought exercise, the reserve stayed the same. There was only always $100,000 of reserves in that economy. So that's why the supply is constant no matter what the federal funds rate is. As long as it's banks lending to banks, the supply of reserves doesn't change. It's completely inelastic to the federal funds rate. But there is a kink up here at the top. Just as demand for reserves runs to infinity if the federal funds rate hits the deposit rate, what we will discover is the supply of reserves runs to infinity if the Fed funds rate were ever to go above what we would call the discount rate. So if the Fed funds rate goes above the discount rate, then the supply would run to infinity. Now think about why that is. If the Fed funds rate went above the discount rate, what banks would do is go and borrow an infinite amount of money from the Federal Reserve at this discount rate, and then they would loan it out in the Fed funds market at the higher Fed funds rate. It's again another arbitrage opportunity. So putting it all together, what we have is a downward sloping demand curve because of liquidity needs and lending needs for banks. However, the deposit rate represents the floor for the Fed funds rate. And the reason it represents the floor is because if the Fed funds rate could go below the deposit rate, there would be infinite demand. Banks would want to borrow as much as they could at this low Fed funds rate and then deposit it with the Fed and earn the deposit rate. The supply curve is vertical because the supply of reserves in the economy is fixed. It is permanent unless the Federal Reserve is involved in the transaction. So as long as banks are lending to each other, the supply is constant. If, however, the federal funds rate somehow went above the discount rate, you would see the supply of reserves run to infinity because banks would suddenly want to borrow an immense amount from the Federal Reserve, so the supply would start getting shocked because they'd want to borrow from the Fed and then turn around and lend it in the Fed funds market. So this is how we think about the market for reserves, and this is how the discount rate and the deposit rate influence the Fed funds rate. So the Fed funds rate is going to operate inside of that corridor, and that's precisely how the Federal Reserve talks about it these days. The discount rate is the ceiling, the deposit rate is the floor, and the Fed funds rate will be in the corridor. And also we should point out that the required reserve ratio also impacts the demand for reserves. So what we need to talk about now is, what if the Fed wants to lower rates? So let's go back for a second and remind ourselves. So what if they're worried about employment? They know that they want to drive interest rates down. The way they're going to do that is by grabbing the shortest end of the yield curve, the Fed funds rate. They're going to push down on that. They're going to hope that every other rate will follow suit. But the question becomes, what are they going to do with these four conventional policy tools to try to drive the target Fed funds rate down? Well, the answer is this. They're going to do an open market purchase. If they do an open market purchase, what that means is the Fed is taking securities from a commercial bank and they're giving the commercial bank reserves. So an open market purchase just means that the Fed is buying securities from commercial banks. What that will do is that will change the supply of reserves. So this vertical red line will get pushed out as the Federal Reserve makes an open market purchase. They will be putting more reserves into the system. So the red line will get pushed out. You can see as the red line gets pushed out, the Fed funds rate will move down the blue line. Now you can guess that they're probably also going to have to lower the floor, the deposit rate. So they'll do an open market purchase, which will move the red line out, and the Fed funds rate will start to move down the blue line. They will also lower the floor, which is the deposit rate, and they'll lower the ceiling, which is the discount rate, because they like to keep that corridor fairly consistent. So lower the discount rate, lower the deposit rate. That drops the corridor. Do an open market purchase. That pushes the supply of reserves out, and the Fed funds rate starts moving down the blue line. Now, they may also lower the required reserve ratio because if you think about what lowering the required reserve ratio would do, that would also allow for the quantity, actually that would change the demand for reserves. So the demand for reserves would pull back. If they lowered the required reserve ratio, then banks wouldn't need as much reserves, so the blue line would pull back. Now, if we're being honest, the Federal Reserve does not touch the reserve requirement hardly at all. They rarely change it. They keep that constant because that gives them a nice reliable shape to the demand curve, and all they do is they mess with these top three: open market purchase, lower the deposit rate, and they lower the discount rate. What if, however, the Federal Reserve is worried about inflation? Well, if you're worried about inflation, you're going to want to drive interest rates up. That might not make sense. Here's a better way to think about it. If you're worried about inflation, do you want more reserves in the system or less reserves in the system? In other words, do you want the monetary base to go higher or lower if you're worried about inflation? And the answer is you want the monetary base to shrink. So this red line is a part of the monetary base, right? The supply of reserves, because the monetary base is currency plus reserves. So to deal with inflation, you want to pull the red line back. So how are you going to pull the red line back? You're going to do an open market sale. So instead of buying securities, you're going to sell them. What that means is you're going to give securities to commercial banks. They're going to give you reserves. So you're pulling reserves out of the financial system. That's going to pull the red line back. As you pull the red line back, you're going to start to move up the blue line, and the Fed funds rate is going to increase. You're also going to have to increase the corridor, the deposit rate, and the discount rate. And those are the three most likely things. Again, they don't usually touch the reserve requirement. All right, so what does it look like? Well, if you're worried about employment, you want to drive rates down. That means you're going to do an open market purchase, which is going to move the red line out. And you're also going to have to drop the corridors. The discount rate is the ceiling. The deposit rate is the floor, and you drop that down. They probably wouldn't actually touch the reserve requirement, but if they wanted to, you could also decrease the reserve requirement. If you're worried about inflation, you want to reduce the amount of reserves in the system to lower the monetary base. You're going to engage in an open market sale, which means you're going to rake in the reserves. You're going to take in reserves from banks. That's going to pull the red line back. You're going to move up the blue line, which is going to increase the Fed funds rate. So you're going to have to move the corridor accordingly, which is the discount rate and the deposit rate. So this right here, what you're seeing on the screen, this represents essentially the summary of this entire lecture on conventional policy tools. But I thought it might be useful for us to do a comprehension check. And so I'm going to ask you, what would happen if the Fed tried to unwind quantitative easing by shrinking its balance sheet? So if the Fed wants to shrink its balance sheet, what it's going to have to do is it's going to have to sell all of those securities. Remember, they have $4.5 trillion on the balance sheet. But if they sell those securities, that is essentially an open market sale. So as they engage in an open market sale, the red line, the supply of reserves, is going to shrink. They will be taking reserves out of the system. That's going to drive the Fed funds rate up. So in essence, they will be pushing up on the short end of the yield curve. If we believe that the yields to maturity on bonds with different times to maturity tend to move together, then as they unwind the balance sheet, as they engage in open market sales, the Fed funds rate will go up and the entire yield curve will tick up. You can see why it's going to be a delicate balancing act. As they try to minimize the risk of inflation by reducing their balance sheet and shrinking the monetary base, that's going to drive interest rates up. If they do that too aggressively, that's going to send us into another recession. If they don't do it aggressively enough, like we said earlier, then that could lead to inflation if we don't shrink the monetary base at an adequate pace. All right, so that concludes the lecture on the conventional policy tools of the Federal Reserve. I have essentially given you all of the material that I want you to have for the semester. We will meet one last time, so please make sure you come to class for our final lecture. I have a guest speaker coming, and with that, I'm going to go ahead and wrap it up.